Hello everyone, I hope you guys are doing well and studies are going in full swing. In today's video, we are going to discuss the all-important CA final FR RTP of May 2025. Sir, is the RTP worth reviewing? Well, this is a slightly above average RTP, I would say, and there are quite a few questions which the institute has kind of changed a little, as well as a couple of completely new questions as well. So what we'll do over here is we'll first cover up the questions which requires most of your focus early on, and then maybe go on to questions which are similar or discuss them quickly. So I'll put the timestamps below the video and you can at least view the first part of the video where we'll cover all the slightly different or new types of questions. And we've mentioned that over here as well. There are 5 questions on a descriptive side which are slightly different that you will review, and a couple of MCQ based cases as well. So let us get started. First, we'll go to the case scenario 2. Over here, this is a combination of Ind AS 16, Ind AS 105 as well as Ind AS 36 on impairment. One point over here, the 10th MCQ is a slightly more interesting one, but for reaching there, we'll have to do the other MCQs as well. So let us review. Case study 2. Choose the most appropriate answer to question 6 to 10 based on the below mentioned facts. On 1st January 2016, 7,500 is the amount, and the asset is acquired with depreciation to be charged on useful life of 10 years, which means 750 per annum will be the depreciation. On 31st December 17, 240, there was an indicator of impairment noted and impairment allowance is accounted for. So this is a 240 impairment allowance. So if I want to find the carrying value, I'll start with 1st of January 2016, for example, which is 7,500. There'll be depreciation over 2 years of around 750 per annum. So this is for 2 years. This is around 1,500 of depreciation, and hence on 31st December 2017, 2 years later, the balance will come down to 6,000. On this date, there's an impairment of 240, and hence 6,000 minus 240. This comes to around 5,760. This will be the revised carrying value on 31st December 17. Now on 20th February 2019, that is a good 1 year, 2 months away, assets have been classified as held for sale. So there will be depreciation at least for the next 14 months. Here, if I look at depreciation, for example, for the 1 year, this is 5,760 divided by remaining 8 years. 2 years have gone by, 8 years are remaining into 1. So this will come to what? 5,760 divided by 8, 720. If I subtract this comes to 5,040. 31st December 2018, it is still not classified as held for sale. It is classified as held for sale on 20th of February. And as a result, there will be further depreciation, but this will be for 2 months. So you will say 5,040 divided by 7 years remaining. This will be annual depreciation into 2 by 12. So this is 5,040 divided by 7 into 2 by 12. This comes to 120 rupees. So depreciation will be 120 rupees and 5,040. This is 4,920. So if I were to find the carrying value on the date it was classified as held for sale, 20th February 2019, maybe this is 4,920. When it is classified as held for sale, the fair value less cost to sell is 4,600, and hence there will be a 105 write-off, also called as impairment, of around 4,920 minus 4,600 comes to around 320. This will be the write-off, and hence on 28th of February 2019, after considering impairment, your value will come down to 4,600. I hope that is clear. Okay. After that, this is a problematic area. You can emphasize here on 30th June 5,300 and fair value less cost to sell given. We will see what is to be done in such cases. Before that, we'll tackle the other MCQs. The amount of depreciation for the year 2018 would be, well, this is for the year 2018. As you can see, depreciation over here would be 720 rupees. Your answer should be subpoint B. This is during the entire year 2018. Now the amount of depreciation for 2019, remember this is only for the first 2 months, would be, I believe this is 120 rupees. As you can see over here, this is 120 rupees. Answer should be subpoint D. Point 8, what will be the carrying value of the asset immediately before it is classified as held for sale on 20th February? Immediately before it is classified as held for sale must be 4920, and after it is classified as held for sale is 4600. So this will be 4920, option A. And then the carrying value after it is classified as held for sale will be 4600, option C. So till now we have discussed these four things, which is a direct application. I don't see any problem here. Now the problem comes in point 10. In point 10, the asset still continues to be held for sale. There's no change in the plan to sell. The asset continues to be held for sale. And if it is held for sale, 105 still applies. Now the general rule over here is when 105 still applies, you will continue to show this asset at the carrying value or the fair value less cost to sell, whichever is lower. Over here, your carrying value will be 4600. The question arises that will there be any depreciation over these 4 months? The answer is no. There will be no depreciation, which means in your ledger, your asset will be at 4600. However, your fair value less cost to sell climbs up to 5300. Now earlier, if you go to see what was your impairment recorded, what was your earlier impairment recorded under Ind AS 105? You had earlier recorded a write-off to the tune of 320 rupees under Ind AS 105. Perfect. So this 320 can be reversed. It is again on reclassification because now the fair value less cost to sell is going up. However, listen to this, and there is an example. I think in our material we have taken question number 12. There's an example in the institute study material as well, where if you are continuing to show the asset as held for sale, then Ind AS 105 continues to apply, in which case the impairment under Ind AS 36 cannot be reversed only, it will permanently remain. However, as a matter of fact, since you can see that your asset is fetching you more, the standard says that over here, as long as the asset is, listen to this carefully, as long as the asset is classified as held for sale, then if the fair value less cost to sell increases, you can reverse up to the combined impairment under Ind AS 36 as well as Ind AS 105. Why? Because if you don't do that, this 240 that you have earlier booked as impairment, now you can do reversal of impairment, but reversal of impairment happens as per Ind AS 36. But Ind AS 36 cannot be applied till the time you are shown under Ind AS 105. So the standard expands its scope and says that as long as you are showing it as held for sale, and there is, let us say, an increase in the fair value less cost to sell, you can reverse up to a maximum of the impairment loss under 105, that is equal to 320 rupees, and under Ind AS 36, which was earlier recorded, that is 240. Here you don't have to do that. Had there been no depreciation, there is that nothing, because you're under a special provision of 105, and hence the standard says that impairment under 105 as well as impairment under Ind AS 36. You can refer question number 12 if I'm not wrong in our material on similar lines, where you are reversing the combined impairment under Ind AS 105 and 36 when an asset continues to be shown as held for sale. This is on similar lines. Under Ind AS 36 in the past, 240 was the impairment, and hence the combined impairment loss that was recorded must be 560. So if I were to reverse 560, your ledger balance goes up to 4600 plus 560 comes to, I think, 5120 or 5160. Does it go above 5300? No, which means you cannot take it up to 5300, but whatever was the loss earlier written off, you can reverse it, and as a result over here the correct answer should be 560. Well, this is at two places, and the ledger balance should be 5160. So your answer should be subpoint C. This is something which is important, which you should review, considering reversal of impairment under Ind AS 36 as well as 105 in cases where the asset continues to be classified as held for sale. There is no change in the plan to sell. At the cost of repetition, you are allowed to reverse up to a maximum combined impairment loss under Ind AS 105 as well as Ind AS 36. Now we'll go to the descriptive questions. Case study 1 largely similar to what is there in your material itself. We'll discuss that later if time permits, but we'll go to the different questions at least. When you go to the descriptive sections, question 11, 12, 18, 19, 20, within which 12 and 20 is non-negotiable. You have to review. Time कम है, ज़्यादा आप time निकालो, but 12 and 20 you have to review. Other questions you will be able to manage, but I would say these are top 5 questions. The other 5 questions are similar to what has been done. So let us review question number 11. Over here, what is happening is you have acquired a 10% stake. 10% stake is investment under Ind AS 109, maybe under FETP or FEOCI. And later you acquire another stake which gives you significant influence. Now in this case, there's a stepwise acquisition of significant influence, in which case what should you do? So that is what we are going to address over here. What needs to be done ideally, at least as per the institute solution, and which seems reasonable, is you will remeasure your investment to fair value at the date where significant influence is acquired, and thereby find the total cost of your overall stake at the date when significant influence is acquired. So let us review question number 11, please. X acquired 10% interest in V for 50,000 on 1st of June 2016 or 2026, whatever. 50,000. This must be investment account debit 50,000 to bank 50,000. The investment in V was accounted for as an equity investment not held for trading, for which an irrevocable option has been availed for subsequent measurement of the financial asset FETOCI. It's 10% stake, which means it is a financial asset which you are recording using FETOCI. X Limited recognized an increase in fair value of 30,000 in other comprehensive income for the year ended 31st March 17, which means your entry would be investment account debit 30,000 to fair value reserve as a part of OCI, also 30,000. Okay, which means your investment will come to what? Investment on 31st March 2017, for example, will be 50 plus 30, that is equal to 80,000. Maybe this can be assumed to be the fair value as on the date, 80,000. Okay, X Limited acquired an additional 25% in V for 2 lakhs on 1st April 2017. Can I say this additional 25%, which means you are at 10 plus 25, that is equal to 35%, which means you have significant influence holding 35%. Out of that 35%, for 25% you have paid 2 lakhs. For the remaining 10%, you already have asset in your books. At what value do you have? 80,000. By the way, it is a fair value. You can also cross verify saying that if 2 lakhs is 25% value, then for 10% the value must be how much? 2 lakhs divided by 25 into 10. Can I say this is also coming to 80,000? So even if this was not given, यहाँ पे तो चलो it is given that there was a 30,000 gain, I could have recorded a fair value at around 80,000, saying 2 lakh is 25% के लिए 2 lakhs, then for 10% what must be the value? Maybe this must be 80,000, and hence 50,000 के ऊपर there must be a 30,000 fair value gain which would have gone to the OCI. Okay, and achieved significant influence, fair enough. The fair value of V's net assets was around 2,50,000 in June, but that does not really matter because you did not have significant influence in June, and it increased to 4 lakhs on 1st April. It does matter because I have to find the goodwill. So this increased to 4 lakhs on 1st April. We recorded profits after dividends of 1 lakh between 1st June and 1st April. Remember, equity method does not apply. Equity method only applies from 1st of April 17, and as a result, your share in profit etc. will only be accounted from 1st April 17. This is just given to throw you off track. How should X Limited account for investment in V Limited on account of the piecemeal acquisition of such investment, provided X has significant influence over V? Past journal entries for the same. Now over here, if I were to look at question number 11, then on 1st of June 2016 probably your entry will be investment account debit. I'm just doing it in rough to bank, let us say 50,000. Then on 31st March 17, I will remeasure the investment. This is investment account debit 30 to a fair value reserve which will go in OCI. Till now, equity stake, you have not really acquired significant influence. However, on 1st April 17, you acquire significant influence, in which case you pass the entry investment account debit. Acha, this investment will now be debited to bank. Now you can either pass 2 entries or put this as a part of a single entry like to bank. For a 25% stake, you would have paid how much for a 25% stake? 2 lakhs or 200,000. But currently your investment was shown at FETOCI. Now can your investment still be shown at FETOCI? No sir. My investment will now be shown under equity method of Ind AS 28. So what I will do is, I will say, let us say, to investment for the remaining 10% stake. This is at the fair value. This is what the institute has done. We do this even in business combination. When there is a step up acquisition and control is acquired, you remeasure the investment to fair value and then you calculate the goodwill, etc. So over here for the 10%, I think this is 80. So your investment now appears at around 280. This is investment on 1st of April 2017. This will be a carrying value of investment. However, when you look at your investment, this is 280. However, initially you also have to identify goodwill, if you remember under Ind AS 28. So over here, if I have to identify goodwill, I will say that your consideration total for a 35% stake is around 280. Against this, I have a share in net assets on 1st April 2017. This is 4 lakhs, I believe, and 4 lakhs into 35% comes to how much? 4 lakhs into 35% comes to 140. And hence I believe that your goodwill, which has to be merely identified, should come to ideally 140 rupees. And this will be your accounting. Later, you have not been asked, you've not been given any further data, so you may not be able to solve further. But if I go to see for question number, I believe 11, there's a 1,40,000 goodwill as we just discussed. Investment 2,80,000 to bank to FVT OCI. However, there is one more thing that we have possibly missed. There was some balance in the fair value reserve of 30,000. That was on investment shown at FVT OCI. Is your investment now shown at FVT OCI? No, your investment is now shown at equity method, which means the balance which is there in the fair value reserve has to be transferred. Since this was an equity investment for 10 months from June to March, which was shown under FVT OCI, it's a part of non-reclassifiable OCI, and hence on happening of certain events, the balance in this will be transferred to, you guys tell me, transferred to what? Retained earnings, because it's a non-reclassifiable OCI, and hence the fair value reserve balance which was there in OCI account debit, which was 30, to the retained earnings. This is like a deemed disposal of investment. Your investment at FVT OCI is getting deemed disposed, and an investment under equity method is getting recorded, and as a result, if investment is not under FVT OCI, then the fair value reserve pertaining to that should also be derecognized. A similar question to that, not exactly same but similar, would be similar to question 72 in business combination, which is also there in this RTP if I'm not wrong. So this is a hidden entry where the balance in the fair value reserve, which was attributable to investment at FVT OCI, here you go, will also be transferred to retained earnings at 30,000. Are we clear with this? Yes, okay. So this takes care of your question number 11. So fairly good data points over here. Then comes question number 12. Now this is a slightly dangerous question, I would say. Now before we jump into this question of financial instruments, Institute has put up a good googly ya fir ek Jasprit Bumrah Yorker for you over here. So it's an unplayable delivery. Unless you have done this, it is a little difficult to understand. So what are we discussing about? Again, the information over here is a little incomplete, but nevertheless, we'll do it from scratch. Now, when you look at your favorite Ind AS 109, Ind AS 109, financial instruments, over here there is financial liabilities. Within financial liabilities, if I were to subclassify, there were two main classifications, if you remember. Financial liabilities, which will be recorded at fair value through profit and loss account. There were, if you remember, 6 items over here. Derivatives, unless hedge accounting applies. Financial liabilities held for trading, if any. Third, financial liabilities designated at FVTPL to prevent an accounting inconsistency or mismatch. Financial guarantee, contingent consideration, and continuing involvement approach. Sir, we don't remember all of this. Don't worry, you don't have to remember all of this right now for this. But if you faintly know that your financial liability at FVTPL, there were 5-6 items that were told that this will be under FVTPL. Other than that, everything else was accounted using, you guys tell me, sir, amortized cost method. So almost all your financial liabilities, loans, debentures, etc. was, almost everything was recorded using amortized cost method. Now, in case financial liabilities are recorded using FVTPL, one of the ways in which financial liability can be recorded at FVTPL will be to prevent accounting inconsistency or an accounting mismatch. Like one example we usually do is, if I were to raise money by, let's say, a 10% bond and invest that money, let's say 10% bond for a period of 5 years, but invest that money in a 11% bond which is for 10 years. In that case, I might say that the bond liability through which I've raised funds may be accounted at amortized cost, but the money I've invested in bonds to earn a net 1% extra, that investment will be at maybe FVOCI because you're holding it in the business model of collecting and selling, in which case there may be an accounting inconsistency or mismatch, and as a result, if there's an accounting inconsistency or mismatch, you are allowed to show both the financial asset, that is a bond investment, as well as a financial liability at FVTPL. If I'm not wrong, this is question number 41 or 42 in our material. You can just review that. So this was a usual exception. Ye question is exception ka exception. So over here, first of all, you need to know that in case there is an accounting inconsistency or mismatch, then you can show financial assets as well as financial liabilities. You can designate them at FVTPL to prevent an accounting inconsistency or mismatch. Point number 1. ये आप अपने mind में lock करें. Point number 2 is, there's a very special case, and we have put a separate earlier. We had put, I think, a separate YouTube video or a short as well for this. I'll just kind of try to link it as well. But what happens in case of FVTPL financial liabilities? Usually financial liabilities using amortized cost, but if there's a financial liability like a loan or a debenture which is issued and you have to record it at FVTPL, usually debenture is not a derivative. It is usually not held for trading. It's not a contingent consideration, not a financial guarantee. Then how can a debenture come under FVTPL? Only if it is to prevent an accounting inconsistency or accounting mismatch. So let us say for the time being, there is some accounting inconsistency or mismatch, and as a result, you have decided to show your debenture at fair value through profit and loss. Now, for example, you take a very basic case. Let us say over here, there is a 10% coupon bond. There is a 10% coupon bond, and this has a face value of around 1000. It has a term of around 5 years, and redemption is going to happen at par. Okay, now if I were to find the issue price, let's say what is the market rate of interest. For example, this is a transaction at market terms. Market rate of interest, for example, is also 10%, in which case you don't need to sit and calculate the fair value. But if you do, we will say that what is the fair value at initial recognition. Let us say you are an issuer. Just a second. What is the fair value at initial recognition? This will be 1000 into 10%, that is equal to, let's say, 100 into the present value annuity factor at the rate of 10% for a period of 5 years, plus 1000 into present value factor at the rate of 10% for the 5th year, which means this is, I think, 3.791. This is 0.621 approximately, and hence this is around 379. 621, this comes to 1000 rupees. So at year 0, what is your journal entry? Your journal entry is bank account debit 1000 to debenture liability or bond liability, let us say 1000. Now let us say this debenture is accounted for using FVTPL, fair value through profit and loss. Now you pay attention. What is happening over here is there's a special clause which is there under Ind AS. Now if it is FVTPL, usually what happens is a fair value is given. You take that fair value and that is end of story. You take that fair value and that is end of story. Over here, let's say some fair value is given at the end of year 1. अभी fair value आप कैसे निकालते हो? You usually find the fair value as the present value of future cash flows. Now what had happened over here is, I'll just give you some background. What had happened over here is, your bond was a particular credit rated bond. Acha, is it necessary that your risk-free rate is also 10%? Now you are not Government of India. You are, let's say, X Limited. Let's say the risk-free rate in the market was 8%. Risk-free rate in the market was 8%. But did you issue the bond at 8%? No, you issued the bond at 10%. When you study AFM, इसको बोला जाता है spread, which means you have a slightly lower credit rating than the government, and hence an investor says कि मैं government को पैसा दूँ तो I want 8%, but मैं तेरे को पैसा दूँ, you have a lower credit rating. Let's say you have AA credit rating, I'll expect a 10% return. So let us say there will be a risk premium because of the entity's credit risk. Big companies like Go Air, etc. have also gone down. Jet Airways, they have also liquidated. So there is a credit risk involved. So as a compensation for credit risk, investors are expecting 2% risk-free rate. They are expecting 8%. Now what has happened now is 1 year later, the risk-free rate changes. Let's say the risk-free rate moves from, क्या करना है? Let's say 8%, the risk-free rate moves to around 9%. But at the same time, your risk premium continues to remain the same. Let us say your risk premium is still 2%. So people say कि भाई ठीक है यार, there is no change in your credit risk. There's no change in the entity's possibility that they may not be able to honor the debt, and hence that is still 2%, which means your market rate of interest now becomes 11%. If I now try to find the fair value is the present value of the future cash flows. You are at year 1. 1 year has gone by, 4 years are remaining, which means this is 100 rupees into the present value annuity factor at the rate of 11% for 4 years. Sir, this appears to be an AFM lecture. Yes sir, unfortunately institute ने खतरनाक question डाल के रखा है. Sir, we are not even doing that question. No, but before that you need to understand the logic. And hence we are doing this at a little bit of detail. भले थोड़ा ज़्यादा टाइम जाएगा, रट्टा मारने से better. So this is 1 divided by 1.11. Sir, don't worry, we are watching at speed viewing. ये आप speed view पे मत देखो. Watch it at normal speed if possible. It's a little complicated. So this is 3.1024. And hence this is 100 into 3.1024 m plus 1000 into 0.6587 m plus MRC. So this comes to what? 968.94, which means this is a fair value. The question will print and give you these numbers. The question will print and give you that at year 0 the fair value was 1000, at year 1 the fair value becomes 968.94, or let's say 969 for simplicity. So over here the question will give you that the fair value of this debenture or of this bond, as the case may be, at year 0 was 1000, at year 1 this is around 969 for simplicity. In which case you have already passed this entry at year 0, bank account debit to debenture liability. Now at year 1, if I just have to find the fair value entries, I will say my debenture liability will have to be remeasured. However, debenture liability will be decreased. Sir, liability was 1000, now इसका value हो गया 969, and as a result 1000 minus 969, there is a 31 rupee reduction to maybe a fair value gain. And sir, ये आप कभी record करते हो? Let us say this is a debenture that you have recorded at FVTPL. So this is, let us say, a debenture that you have recorded at FVTPL to prevent accounting mismatch. To prevent mismatch / inconsistency. So हमने बोला कि भाई for whatever reasons this debenture 31 rupees. कोई बच्चा बोलता है सर ऐसे कैसे गेन हो गया? It is like saying that if you go to issue a similar debenture, or you go and say in the similar debenture in the market 11% ब्याज पे करना पड़ेगा, your debenture you are paying only 10% gain, and hence that is kind of a gain for you. For something which in the market people are paying 11%, you are paying 10%. Or fundamentally, if I had to go in the market and मेरा plan था कि भाई ये debenture मैं पूरे 5 साल नहीं चलाने वाला हूँ, I'm going to early repurchase a debenture. If you early repurchase a debenture, you will have to pay only 969 on this debenture, where you got 1000 rupees, and hence 31 is your gain. And because this is FVTPL, this gain or loss will go to the profit and loss account. End of story. हाँ sir, perfect. Now the problem is, what happens if your risk-free rate, for example, increases by 1%, no problem. But at the same time, what is recently happening with Vodafone Idea, they are facing a lot of financial difficulties. They even did a follow-on public offer and they were finding it difficult to pay the telecom license fees, etc. They were facing earlier, a few years back, no one thought that Vodafone might default, but over the last few years, people were saying that there is a possibility. In fact, Kumar Mangalam Birla sir also said that if this continues, we might not be able to continue the way it is happening. So there was an increase in credit risk. Vodafone has issued the bond, but now with all of this noise around, a new investor who is planning to invest in Vodafone would say that I need compensation for 9% risk-free, definitely, but Vodafone's risk premium is no longer 2%. Maybe Vodafone's risk premium is now 4%. And as a result, if your risk premium is revised, over here, risk-free rate is 9%, but your risk premium now is, for example, 2K badle 4%. Which means an investor requires 13% return from Vodafone. When it was issued 1 year back, people said, ye to acha khasa company, and we were happy at 11%. But now people expect a 13% return from a Vodafone investment. And as a result, if I sit to calculate the fair value, this was fair value calculated at the rate 10% originally. This is calculated at 11%, assuming there is no change in the credit risk. This 969 was if there is no change in entity's own credit risk. Sir, ये language का मतलब क्या होता है? Which means earlier also over the risk-free rate you were expecting 2%. Now also you are expecting 2%. There is no change in your risk. By the way, inflation, time value, risk-free rate is changing, and hence you will have to, you will require 11%, but not because you have become more risky. Market में inflation बढ़ गया. But when I look at this situation, is there an increase in credit risk as well? Yes. But इससे क्या होता है? Counterintuitive thing happens. What happens over here is, if you now sit to calculate the fair value at year 1 at the rate 13%, an investor will now say that I require 13%. How many years are remaining, sir? Still 4 years are remaining. What is the present value? Present value at the rate of 13% for a period of 4 years plus 1000 into the present value factor at the rate of 13% for the 4th year. 1 divided by 1.13, 1, 2, 3, 4, 0.6133, grand total 2.9745. If I were to multiply this, I will get the fair value. Sir, this is AFM? Yes, sir. This is AFM. However, अगर आपको समझना है तो थोड़ा मेहनत करना पड़ेगा. सर डोंट वरी, बोथ ऑफ देम आर इन ग्रुप 1. वी हैव स्टडीड बोथ. याद नहीं है, बात अलग है. सो ओवर हियर दिस इज 100 into 2.9745 m plus and 1000 into 0.6133 m plus. This is 910.75. Let us say approximately 911, 911. I think US में ऐसा इमरजेंसी नंबर है, if I'm not wrong. ठीक है, हमारा भी वही हालत है. So over here, let us say 911 is a fair value at the rate of 13%. Now, what happens over here is, when your bond was originally recognized, at 1000. Later it became 969, for example, if there was no change in entity's own credit risk. तो बोले 31 रुपीज का फायदा हुआ है. ठीक है, हुआ है, बिकॉज मार्केट में 11% was the rate. You are paying 10%. There's no change in your credit risk. You are paying lower. Or if you had to buy back, you will buy back at a 969 price as opposed to 1000 that you received. So 31 ka gain. FVTPL gain should go to the PNL account, no problem. But at year 1, if your own credit risk has also changed, then the fair value comes to 911 rupees. Now, if I compare 1000 directly with 911, there appears to be an 89 gain. You will say 89 का gain PNL में जाना चाहिए भाई, FVTPL. Now what is the problem over here? If you take the entire 89 gain to the P&L, you are patting your back. You said shabash beta. In the liability, we issued liability at a time when the rates were 10%. Now the rates become 11%. Pat on your back. You issued a fixed interest loan when the rates were lower. So you are paying a lower rate of interest. तो वो आपका फायदा हुआ. But when I look at, that is the journey from 1000 to 969. When I look at 969 to 911, that so-called gain, 969 minus 911, maybe 58 rupees, is because your credit risk has deteriorated. No one is ready to touch your bond. You are the issuer, you are Vodafone. No one is ready to touch your bond. Sir, we are not even ready to touch Vodafone network, but nevertheless, we are not ready to touch your bond at 969. Why? Because now it is significantly more risky. If I want to buy the bond, I want a 13% return. In which case, Vodafone's credit rating is deteriorated. And if Vodafone's credit rating is deteriorating, is it good for Vodafone or is it bad for Vodafone? Think and tell me. So that is not a good move. Value of your bond is reducing. It is like saying Go Air or Jet Airways, they are on the verge of liquidation. When they issued their bonds, they were at 1000. Let's say market interest rate remains the same. However, the credit rating of Jet Airways falls. 1000 ka bond becomes, let's say, 200 rupees ka bond. So apparently in the books of Jet Airways, 1000 का liability था, अभी वो 200 का हो गया. There's an 800 gain. So should I clap and pat on my back that 800 gain हुआ है? No sir, that gain is happening, that so-called gain is happening because your credit rating is falling, because you are unable to pay, because people are not considering you to be a good company, and such gain should not be reflected in your profit and loss account. And ये small, rarest of the rare case, but exam में कुछ भी आ सकता है. Sir, exam में नहीं है, RTP में, we'll pray for that, but exam में आ गया तो we should be prepared. And hence, over here, what we will do is at year 1, the difference between 1000 to 969 is not because of your credit risk. It is because market में risk-free rate change हुआ है. However, now that your bond has come to 969, the journey from 969 to 911, that is because your bond's own credit risk is falling, and such gains or losses will be parked in OCI. I will not pat my back on my P&L and increase my PAT saying that brilliant, you are now having lower credit rating, you may not be able to repay your loan. नहीं यार, पहले तो ये होना ही नहीं चाहिए, but if it is FTP, you have to consider it. So over here, we'll have to take it to fair value, and fair value is 911. So this is debenture liability account debit 969, which is a liability after the above entry, minus 911, which is, I believe, 58. To what? OCI, other comprehensive income. So this is gains or loss due to changes in own credit risk, comes to 58. So what do we remember if financial liability is recorded at FVTPL? Remember, all of this problem will arise only if your financial liability is recorded at FVTPL. If it is at amortized cost, you don't even look at the fair value. So this will be if financial liability at FVTPL. This is usually in order to prevent an accounting inconsistency or an accounting mismatch. Now in this case, the financial liability will be recorded at FVTPL. Now in this case, if there is a fair value gain, or it can also be a loss, if it is purely due to changes in market rate of interest, like in our example 1000 से लेके 969, you guys think and tell me, where will the gain or loss go? Sir, profit and loss. Whereas if it is due to changes in entity's own credit risk, in our example Had there been no changes in credit risk, for your bond, investor would still expect 11%. So 969 here rehta tha, there will be nothing else. If nothing is given, your answer will end over here. However, if there is a further change, 969 minus 911, this will be in other comprehensive income. I believe you will have to probably, we will discuss the RTP question as well, but you'll have to probably rewind and review this all over again because it is a slightly more complex thing. Institute material had some theory, but it did not have a sum. Suddenly they put a sum in your RTP, and that is also not a complete question, but nevertheless, if it has come, you do this, understand this, and proceed further in case something like this turns up in your exam. My sympathies are with you, but beyond that, nothing much can be done at this stage. So let us review question number 14 on your RTP. Very, very important question, a completely different question as compared to questions that you might have reviewed in the past, something that you have to review. Chaliye, on 1st of April 2011, listen, if you want you can pause and read this all over again first. On 1st of April 2011 or 2021, ABC issues a 10-year bond with a par value of 15 lakhs, face value of 15 lakhs, an annual fixed coupon rate of 8%, which is consistent with the market rates for the bonds with similar characteristic, which means, is this at market terms? Yes, if it is at market terms, the fair value will equal to the transaction price, which I believe is 15 lakhs. अगर भरोसा नहीं होता तो आप calculate कर सकते हो. But otherwise, the par value is 15 lakhs, coupon rate is 8%, which is consistent with the market rates of bonds with similar characteristics, which means your required rate of return of bonds will also be 8% with similar characteristics. And as a result, over here, this will be 15 lakhs fair value is equal to transaction price. ABC uses secured overnight financing rate. In your AFM also we might have discussed this. This is SOFR. Earlier LIBOR करके हुआ करता था, London Interbank Offer Rate, but then LIBOR में काफी सारा rigging हो रहा था, and hence they moved from LIBOR to benchmark rates like SOFR, SONIA, etc. If you see a lot of your May 25 changes in AFM are just replacing LIBOR with SOFR, that's it. So ये सिर्फ एक rate है, अपन मान के रखे like a LIBOR rate or an RBI based rate or basically like a risk-free rate. Sterling overnight financing, secured overnight financing rate as its benchmark interest rate. At the date of inception of the bond, SOFR is 5%. Are you raising the loan at 5%? Are you raising the loan at 5%? No, sir, we are raising it at 8%. So that means considering your credit risk at inception, people are demanding how much risk premium? Sir, 3%. At the end of the first year, baad mein. First, if I look at the facts of this case, at year 0, it's a 10-year bond. At year 0, what is happening? Question number 12. At year 0, this bond has a fair value equals transaction price equals 15 lakhs. Coupon rate, which is equal to the market rate of return which is expected on our bond, is 8%. However, at this point SOFR is around 5%. At this point only it is 5%. Therefore, how much is a risk premium? So I would say that if I am paying 8%, SOFR is 5%, which means for my risk, people are expecting a premium of how much? 8 minus 5, that is equal to 3%. There is a risk premium of around 3%. This is in AFM language spread. Okay, sir, क्या झेलना पड़ रहा? At the end of the first year, SOFR decreased to 4.75%. Okay, so if your credit risk remained the same, this must be 4.75 plus 3. It should be 7.75%. Had your credit risk remained the same, it can increase also, it can decrease also. But had it remained the same, then people should have required 7.75% from your bond at the end of the year. The fair value of the bond is 15 lakh 38,110. This is given at year 1. This is consistent with the interest rate of 7.6%. what is happening here? If I go to year 1, your SOFR is 4.75%. If own credit risk remains the same, your required rate for your bond, the required rate for our bond should be what? Sir, the required rate for our bond should be 4.75% plus 3%, that is 7.75%. Now at 7.75%, what would be the fair value? We can find that. That would have been the market value had there been no change in credit risk. आपको तो एक fair value दे के रखा है. You have been given fair value at 15,38,110. 15,38,110, but this is at the rate 7.6%. This is given to us. But my point is, this is like 911 given to us. This is final 7 at 13%. It is like saying at 13%, fair value is 911. But I want to find the breakup of how much of it is because of changes in own credit risk, how much of it is due to market factors. So over here I say that, okay, if there was no change in entity's credit risk, if own credit risk remains the same, required rate would have been 7.75%. What will be the fair value at 7.75%? This is the present value of future cash flows. What are the future cash flows? Sir, 15 lakhs into coupon rate of 8%. 15 lakhs into 8%, if I am not wrong, will be 1,20,000. 1,20,000 into PVAF at the rate of 7.75%. Remember, it was a 10-year bond. 1 year has gone by, 9 years are remaining. And hence you will take this for 9 years. I'll again repeat, 1 year has gone by, 9 years are remaining. So this is 9% plus. At the end of the 9th year, 15 lakhs into the present value factor at the rate of 7.75% for the 9th year. देखा जाएगा. ठीक है. The remaining cash flows of the bond are 1,20,000. Even if this was not given, we could have calculated it 15 lakhs into 8% for 9 years. Again, 10 years का bond था, 1 year has gone by, 9 years are remaining. We could have done that. हमको spoon feeding नहीं चाहिए. नहीं sir, चाहिए ऐसा मत बोलो. And 15 lakhs at the end of the 9th year. These cash flows are discounted at 7.6%, equal to 15,38,110. Okay, so if you discount all of this, what they are trying to say is, ये 1538 आया कहाँ से? This 1538 का पूरा background दिया है. This is 1,20,000 into the present value annuity factor at the rate of 7.6% for 9 years plus 15 lakhs into the present value factor at the rate of 7.6% for the 9th year. ठीक है. This is how you found 15,38,000. If you want, you can sit and calculate it. Approximately same answer here. ABC assumes a flat yield curve, which means the rates are expected to remain the same in the future. And all changes in interest rates result from parallel shift in the yield curve, and that changes in SOFR are the only relevant changes in market rate. So when SOFR changes, that is when market conditions are changing. Other than that, there is no other change. ये पूरा आपका AFM का interest rate का चीज यहाँ पे छाप दिया लग रहा है. When you see this question, you will assume कि sir AFM का question FR में आ चुका. Yes, and the following discounting factors may be considered. At 7.75%, present value of 1 rupee. At the end of 9 years is 51.1 paise, that is 0.511 rupees. Cumulative for 1 to 9 years is 6.312. This is PVAF. And then I don't know what they are given over here. At the end of year 10, cumulative, maybe they have given this at 7.6%, I don't know. शायद से वही होगा. So over here, we will say at 7.75%, if I want to find a value, this will be 6.312, 6.312 and 0.511. which means 1,20,000 into point या फिर into 6.312, 757, 440, 15 lakhs into 0.511, 766, 500. If I total both of these, we should be getting what? 1532, 940 if I'm not wrong. 1532, 940. So ideally, your fair value, if there was no change in the credit risk, should have moved from 15 lakhs which was initially to 1538, 940. If there was no change in credit risk. But यहाँ पे credit risk में change हो रहा है. Maybe just for your knowledge, what is happening is 7.6% equals 4.75% plus risk premium. So if I do 7.6 minus 4.75%, this is 2.85%. Your risk premium is becoming 2.85%. So now you are becoming probably less risky. But that is again changes in own credit risk.Maybe more risky, maybe less risky, but this is changes in own credit risk. So that is why आपका fair value 1562 ना देखे. Let us say if there was no change in own credit risk, then this rate would not be 7.6%, it will be 7.75%. In which case, a fair value would have been 15,32,940. However, the fair value is 15,38,110. So over here, what is happening is when you are looking at bond fair value change, your bond's fair value, which was 15 lakhs, has actually gone up to 15. 38, 110 if I'm not wrong. 1538, 110. एक second now. And hence there is a fair value change of around 38,110. A part of this is due to market changes, due to market factors which are changing. Acha, had there been no change in the credit risk, your answer would have come to what? 1532, 940 if I'm not wrong. मेरे को ये verify करना पड़ेगा. So this is 1532, 940 as compared to 15 lakhs, which means your liability is increasing. So there is a 32,940, but ये तो P&L में जाएगा if your accounting was done using FVTPL. But due to changes in own credit risk, now from 1532, it's actually at 1538, but that is because you are becoming more risky, you are becoming less risky, so your bond is becoming more and more valuable to the investor. 1532 के बोले 1538 because now you are less risky. आपके लिए बोलने के लिए नुकसान है, आप अपना सर कूटोगे. You will say, अरे यार, I am less risky, investors are willing to pay more. That is good for you. But वो आपका loss दिख रहा है. That is not a loss to be taken to P&L account. Like in our example that we discussed of 911, it was the opposite case, where you are becoming more risky. Being more risky gave you gain. That gain is not the right gain to go to the P&L. It is counterintuitive. If you become more risky, it is bad for you. तो उसका gain नहीं दिखाना चाहिए P&L में. In a similar way, when you become less risky, it is good for you. But being good for you, there is going to be a loss because investors are favoring your bond and they are ready to pay more. So आपकी जो bond liability है वो value बढ़ रहा है. You will have to rewind and listen to this in all likelihood. But it is counterintuitive things कि भैया ठीक है मैं तो less risky हो रहा हूँ. Earlier my risk premium was 3%, now it is 2.85%. But because of that, investors, if you understand AFM properly, investor would say, okay, I'm ready to pay more for your bond. But मेरे books में तो liability है, and hence the value of the liability increases. So I'm doing a good thing that is becoming less risky and my value of liability increasing. तो ये loss नहीं होना चाहिए in my P&L and hence I take it in OCI. So moral of the story इतना याद रखें, इसके आगे ज़्यादा बेचा ना करे, अदरवाइज आपका भरोसा उठ जाएगा, राइट. सो दिस इज 15,38,110 minus, I believe, 15,32,940. I hope I have done the maths correct. 51,6.312. I believe this should be, we'll verify it once. 15,38,110 minus 15,32,940 comes to, I think, 5,170. एक बार वापस रिव्यू कर ले. एक second, I don't see, these numbers are not as familiar. Over here, what is the fair value? 15,23,940. This is 15,2.511. 1,20,000 into 6.312. I seem to have done some calculation mistake here. एक second. मेमोरी में गड़बड़ हुआ है क्या? 1,20,000 into 6.312. 757,440. This was what? 6.312. ठीक है. Then you have 15 lakhs into 0.511. Was it 0.511? Yes. M plus 766,500 MRC. क्या कर लिया? अरे मैंने, what do you used to call this? 15, 23 and 32. वो क्या कास्टिंग एरर या कुछ रेक्टिफिकेशन ऑफ एरर में आता था. I've written instead of 23, I've written 32. ठीक है, चलो, बट भावनाओं समझो. So this is 15,23,940. So over here 15,23,940 minus 15 lakhs comes to what? 23,940. And the difference over here again will be 15,38,110 minus 14,170. अच्छा, where will 14,170 go? Other comprehensive income, which means if you have to pass the journal entries at year 0, your entry will be bank account debit 15 lakhs to कौन सा liability है? Bond liability 15 lakhs. Now obviously there will be some interest entry as well. Institute has not asked you to pass entries, but nevertheless we will pass. इतना खतरनाक question है. So there will be interest entry as well. So this is interest account debit. Let us say to bank it is FVTPL. There is no amortized cost working, which means 1,20,000 of the first year that you pay is your expense to be recorded. Then you go to year 1. Over here this is FVTPL. We are assuming that this is FVTPL to prevent accounting mismatch. तभी तो ये सब का application आएगा. So over here, this will be at year 1. Your bond liability increases from 15 lakhs to the fair value. Fair value is 15,38,000. So this is to bond liability 15,38,110 minus 15 lakhs comes to 38,110. But a part of this is due to market factors changing, a part of it is due to own credit risk. So there will be a fair value loss which will go in the P&L. How much will that be? So due to market factors, 23,940. And there will be certain, this is like a non-reclassifiable OCI. There will be loss due to ओन क्रेडिट रिस्क. बट ये तो आपका क्रेडिट रिस्क कम हुआ तो काउंटर इंट्यूटिव है, लॉस नहीं होना चाहिए. बट द फेयर वैल्यू इज सच दैट पीपल आर रेडी टू पे मोर फॉर योर लायबिलिटी. सो इफ यू हैव टू बाय बैक योर डिबेंचर्स यू हैव टू पे मोर. ये तो उल्टा हो गया. इफ यू हैड टू बाय बैक योर डिबेंचर्स नाउ, had there been no change in the credit risk, then 15,23,000 pay करके हो जाता था. But now you are becoming safer, so people value your bonds more. But if you want to buy it back from the market and pay off the investors, you will have to pay 15,38,000, so you will have to pay more. तो आपने अच्छा करने की सजा भरी. But currently you are not buying back your debentures, so that thing I don't want to show it as a loss. It is because of my better position. So to negate that counterintuitive effect, they say loss due to own credit risk will be put in OCI. It is a non-reclassifiable OCI, will not go in the statement of P&L. This will be 14,000 170. 14,170. Sir, pasine chhut gaye. So over here, this is 14,170. What is the amount transferred to OCI at the end of year 1? Sir, today night we will see this in our dreams as well. We will be able to write 14,170 when the bonds are measured at fair value. The question has clearly told you bonds are measured at fair value. It must be FVTPL. So if the bonds are measured at fair value, maybe this is to prevent accounting mismatch or inconsistency, because otherwise this bond liability will not be measured at fair value. It will usually be measured at amortized cost. If it is at amortized cost, ये सब करने का जरूरत नहीं. But if it is measured at fair value and all of this comes, that is when you will have to apply this. ठीक है? So we have spent a fair bit of time over here as if we are doing it afresh, but I do believe it was required over here. Unless you do that, it is difficult to kind of get an understanding. I hope आपको थोड़ा understanding मिला. Unless you review, understand, sit through it with the example and the sum, you will have to spend some time. But once it is understood, आप कभी नहीं भूलोगे. तो आप एक बार कर लो please. इसके डर से अभी एक बार इतना time, if you have reached till here, then don't let it go. Review the example that we discussed in these notes. If possible, I'll share this on Telegram as well. And also the sum, do that afresh, spend some time, and once you remember it, you will not forget it surely. Okay? Chaliye. So that is taking care of question number 12. Next you go to question 13, 14. Most of these questions are broadly similar. We'll discuss them. Later we will do. So over here we have mentioned like this question is similar to the early redemption question of compound financial instruments, question number 47 of Ind AS 109. This is early redemption, but just that यहाँ पे interest is half yearly. In our question, interest was annually. Question 14 is exactly similar, exactly same, not even similar, to question 72 of business combination, Ind AS 103. This has come multiple times earlier in the RTPs, MTPs, even in the main exam. So you should have done this definitely. 14 as well. 15 is same, or rather broadly similar as a question on deferred tax, Ind AS 12, where you have this holding and subsidiary and you have tax base, book value, fair value. You find the temporary differences by comparing fair value and the tax base, calculate deferred tax. Similar, nothing new over here. 16 over here is similar to question number 14 that we did of Ind AS 21. Again, there is a foreign currency translation reserve and you are losing control over a subsidiary, in which case what you will actually do is you will remove the net assets, you will remove the NCI, but you will also transfer the FCTR, your share of FCTR, to profit and loss account. So we'll discuss this later if required. Question 17 is exactly same as question 6 of Ind AS 2. So the questions from 13 to 17 are same/similar questions to what is there in your material. If you have not done that, you better do it. But if you have done that, it's fine. I mean, you just read this question and you will clearly know that, okay, this is something that you've done earlier. So we're not currently going into that. 18, 19, 20. Even 18 and 19 are relatively manageable, but are slightly different. So we'll discuss that. 20 is again, so 12 and 20 are two non-negotiable questions in this RTP. Chaliye, let us go to question number 18. The opening balance sheet as at 1st April 2016, for example, of an Indian company which accounts for transactions in INR consists of cash of 1 lakh and share capital of 1 lakh. So over here, this is like a shell company to start with. There's a cash of 1 lakh, share capital of 1 lakh, nothing else. The company borrows a long-term loan on 30th September 2016 for $2,200 when the exchange rate is 87 per dollar. So over here, this is, you will record this at the exchange rate prevailing as on the date of transaction. 2,200 into rupees 87 comes to what? 2,200 into 87 comes to 1,91,400. Maybe this loan you have taken in dollars, but you will convert this money into rupees, and hence bank account debit will be 191,400 to, let us say, I believe, what is this? Loan 191,400. In all likelihood, you have received the money in dollars, you would have converted it into rupees, but your liability is still to repay in dollars. There are no other transactions during the year. Kya company hai? The exchange rate as on the balance sheet date is 85 rupees per dollar. Now, loan is a liability. Remember, loan is a liability, and this liability will be recorded being a monetary item at the closing rate. Okay, closing rate is 85, so you'll have to remeasure the loan at 85 for sure. So over here, there will be a forex gain or a loss, as the case may be. So a loan of 87 will now be at 85, so there will be a forex gain. So over here, this is loan account debit to forex gain, and this forex gain will go to the P&L. 87 minus 85 into, I believe, 2200. So can I say this is a 4400 gain? A gain or loss on a monetary item, remember, has to go to the profit and loss account only. This will ideally go to the P&L. The summarized balance sheet as at 31st March 17 is as follows. Cash is given as 1 lakh and 1,91,400 received, 291,400. This will be your closing cash balance. Share capital is 1 lakh. Retained earnings, maybe during the year, there must be P&L, a forex gain on loan of 4,400. ये वाला gain यहाँ पे आएगा. Okay, then there is a long-term loan. A long-term loan at 1,87,000. Sir, how did you get 1,87,000? Well, the loan was 191,400 and then 4,400 less kiya. That will come to around 1,87,000. Is everyone clear with this? Okay. Then you have total equity and liabilities. How will the foreign exchange difference from unsettled transaction be reflected in the cash flow statement? Now you have not been told which cash flow statement. It can be cash flow under indirect method, it can be cash flow under direct method. We will do both of them. So if I look at question number 18, under, for example, indirect method, on the other side, let us say under the direct method, there will be CFO, there will be CFI, there will be CFF, cash flow from financing, same, cash flow from operating, cash flow from investing, cash flow from financing. Now then you'll have net changes in cash and cash equivalents, and then you will have plus opening cash and cash equivalents. That will ultimately come down to a closing cash and cash equivalent. Same working over here, there will be net changes plus opening will come to closing. Okay, let us populate the data. Opening cash is 1 lakh and I clearly know that the closing cash is 2,91,000. कितना है? 2,91,400. 291,400. This is your closing cash. So I want to find the net change in cash and cash equivalent. To be honest, during the year, the only cash flow in my understanding is loan taken. Money that has come into the company's bank account is loan taken on 30th September. That is the only cash flow. That is a financing activity. Loan taken. When the loan was taken, in my bank account, I received how much? Sir, bank account debit 191,400 to loan 191,400. Okay. So this is cash flow from financing. 191,400. Either ways, whether you look at direct method or indirect method, loan taken will be 191,400. Acha, by the way, there's no cash flow from investing. In direct method, there is no sales, no purchase, no salary, no tax, and as a result, direct method, there will be no direct cash flow. But under the indirect method, you will start with net profit. Net profit is 4,400, but this 4,400 is on account of 4,400 gain on loan, which is a financing item, which is a non-cash item, and as a result, it has to be reversed. Whether you call it as non-cash, whether you call it as financing, you'll have to reverse it, and as a result, this will be forex gain on loan, which is to be reversed, and hence this will be 0. Ultimately, your net changes in cash and cash equivalent is 1,91,400. You add that to the opening cash, will come to 2,91,400, and that is about it. कोई खास बड़ा बात है नहीं. It is just under indirect method. You will have to do this adjustment. That is about it. Okay. So whatever it is, we have covered this question number 18 of cash flow. Next you go to question number 19. Now this is related party disclosures. Mr. Y's father. Mr. Y's father, is father a close family member? Of course sir, ऐसा मत बोलो. बाप बाप होता है, बेटा बेटा होता है. beta, beti, whatever. Mr. Y's father owns 100% of shares in A Limited. Okay, that's fine. Now Mr. Y and Mrs. Y together, two body, one soul together. Mr. Y and Mrs. Y, husband, wife maybe, own 100% of shares in B Limited. Okay, and Miss Z, who is Mrs. Y's sister, provides bookkeeping services from time to time to B Limited. Pura khichdi pakka hai. So what we have done over here is we have tried to prepare a chart. We have said ho kya raha hai beta wo batao. So there is Y's family, that is Mr. Y's family, that is father, has 100% stake in A Limited. Again, Y's family, that is father of Mr. Y, has 100% stake in A Limited. Okay. That same Mr. Y, along with his wife, Mrs. Y, that is close family, has control over B Limited. Now in B Limited, there is Miss Z, who is Y's sister. Mrs. Y's sister, and Mrs. Y has controlling relationship. In B Limited, Mrs. Y's sister is providing some bookkeeping services. Bookkeeping services, in my understanding, is not key managerial service, and hence Miss Z is not a key managerial personnel in my opinion. Perfect. Institute has also not taken it as key management personnel. However, Miss Y is not an employee of B Limited. That is fine, but some payment is going to Miss Z. No? They may not be an employee, but there is a transaction. In related party transactions, you have to disclose transactions. A Limited has increased its loan of 1,50,000 to B to 2 lakhs during the year, for which A Limited charges a below market rate of interest. Now the problem is, between A and B, is there a related party relationship? Who all are related parties? First of all, if I look at A के लिए कौन-कौन related parties है? Is Mr. Y's father a related party? Yes, they have control. Acha, if Mr. Y's father is related party, then all the close family members who can influence or be influenced, that is the son, their family member, all of them will be related. So Y's father, Y, Mrs. Y, can I say all of them are related parties with A? However, what about A Limited and B Limited? Ye sabse important hai. What about A Limited and B Limited? There's a transaction between A Limited and B Limited. Is B Limited a related party? Yes. Under clause E of the related party corporate relationships, we will say that B Limited is controlled by Y and his family members. The same close family members of Y also control A. Therefore, A and B are both controlled by Y and their family members, and hence A and B are related parties, and hence if there's a transaction between A and B, that requires disclosure. Okay. Abhi, when I look at B Limited, again for B Limited, A Limited is a related party, but other than that, also Mr. Y, Mrs. Y, even Miss Z, who is a sister of Mrs. Y, Miss Z, जो भी है, ज़्यादा भावुक ना हो जाए, Miss Z is not providing key managerial services, but Miss Z is doing some transaction, and Miss Z is a close family member of the person having control, and hence the transaction with Miss Z will also require disclosure. Okay, sir. State whether Mr. Y's father and Mrs. Y's sister are related parties of B Limited. The answer is yes. They are asking for B Limited. The answer is yes. They are related parties. Why? Because they are close family members. The father as well as sister, they are close family members because they are generally likely to be influenced or be influenced. Sisters, brothers, fathers, children are treated to be close family members, and hence they will be related parties. Second, what disclosures is to be made in the finance statements of both A Limited and B Limited in respect of loan given by A Limited to B Limited? Well, for both of them, they will show the transaction that have happened during the year. During the year, I think 50,000 of loan was given, but at the same time, you will also show outstanding balance. At the beginning and at the end of the year, this is as 2 lakhs. Further, the fact that the loan is at concession interest rate, that can also be additionally shown. So over here, you will show the transactions and the outstanding balances. In the books of A, that is loan given. In the books of B, that is loan taken. But nevertheless, that disclosure will have to be taken in the case of both the companies because it is between related parties. Whether B Limited is required to disclose the dealings with the sister of Mrs. Y in the final statements. Again, the answer is yes. तीनों का answer yes, yes, and over here disclosures to be given. You need to disclose. Why? Because she is a close family member of a person who is having control, and hence the transactions with Mrs. Y or even the close family member of Mrs. Y will require disclosure irrespective of whether they are KMP or not. Are we clear with this? Yes. So this is regarding related parties. And then you come to question number 20, another nightmare of a question. So you will mark this as important. Now this is a question which is very different from the question that we have done. Now on the face of it, it will appear to be similar to what you have done, but this is not. When you did Index 102, share-based payment, remember you had a question of ESOP with cash alternative. We said it is very, very important. Now usually what happens in case of an ESOP with cash alternative is a company comes to an employee, they say, well, employee Raja, you come to me and work with me. You work with me for 3 years, and after 3 years, I will give you a choice on whether you want to exercise and take shares. You can take, let's say, 200 shares of my company, or you can decide, emphasis on that word, you can decide whether you want cash equivalent to, let us say, 150 shares. You might have done sums like that. In such case, there were certain steps that you will find on the grant date, fair value of the equity plan, then fair value of the cash plan, and then find the value of an equity option that you are giving to the employee because you are giving option to the employee. Are we clear with this? And then you do the accounting for the cash plan as if it is a pure SAR, for an ESOP plan or the equity option for that matter as if it is a pure ESOP, and then you do the workings. That is one thing. But this is to be done when the employee has a choice, that if the employee wants cash, employee takes cash, employee wants shares, employee takes shares, which you will have choice once you become CA. You will take those. Sir, ख्याली पुलाव मत दिखाओ, but let us पहले CA तो बन जाते. अच्छा, this question is slightly different. When you will see this question, when you will read this, it will appear that either the company can give shares or the company can give cash. But here the company will not give an option to the employee. Company also will not have an option. There will be certain conditions. If those conditions are fulfilled, shares will only be given. If those conditions are not fulfilled, cash will only be given. And as a result, this is not similar to an ESOP with cash alternative. When you read this, you'll say, sir, ये तो ESOP with cash alternative लग रहा है, where there is an alternative with the employee, option with the employee. Here there is no option with the employee. You will study that question. Further, before you read this, another important point you need to remember is when you look at an ESOP plan, there are multiple vesting conditions. One is a service condition, that is you have to work for 3 years, 4 years, whatever it is, that is service condition. Second is performance conditions. Performance conditions, if you are aware, can be market link, can be non-market link. If it is a market link performance condition, you will take the position on the grant date and do working based on that estimate only. If you can't change the market based fair value, you can't even change the estimates. However, it is a non-market link performance condition, like it is not linked to market price or market price growth, etc. It may be linked to earnings, it may be linked to net profit, it may be linked to production, it can be linked to any factor other than the market. Then you assess at each balance sheet date the probability of that event happening, and accordingly you do the working considering the possibility of the conditions being vested or not. Sir, ऐसा नहीं समझ में आ रहा, we'll have to do it with numbers. ठीक है, I'm just giving you a background because you will, this is a sum like this is not there at least in the institute material. चलिए, let us review this question. Question number 20. On 1st April 20, let's say 21, an entity enters into a share-based payment arrangement with its employees. The terms of the award are as follows. First, the employees are required to work. So what is the grant date? I believe 1st April 2021. The employees are required to work for the entity for 5 years, after which they will receive a cash payment equal to the value of the entity's share. So this is similar to a SAR, like a cash plan. However, for this there is a 5-year service condition. So if they render service for 5 years, then we are ready to pay the cash price equivalent. If the entity achieves a successful IPO during the 5-year period, the employees will receive free shares rather than cash payment. Whenever the company does an IPO, if the company does IPO in the first year, then shares will be given in the first year. Third year, then shares will be given in the third year. Fourth year, then shares will be given in the fourth year. But if till 5 years the company is unable to do the IPO, then we will pay cash. You think and tell me, does the employee have a choice over here to demand shares or demand cash? Does the employee have a choice? No. If the successful IPO happens, necessarily you are going to give shares only to your employees. Employees को चाहिए भी cash, तो you are not going to give. But if the IPO does not happen, even if the employee are okay, नहीं मेरे को share दे दो, you will not give the shares. And hence, to treat this plan as an ESOP with cash alternative is wrong. This is a plan where you are telling the employee कि देख, if the IPO happens, I will give you free shares whenever the IPO happens. Which means over here the vesting might happen before 5 years. You have to stay for 5 years, but if the IPO happens before 5 years, I am ready to give you free shares. Vesting might happen before 5 years, but that is only if the IPO happens before 5 years. Now, what do you guys think? Happening of IPO or not happening of IPO? Is it linked to any market price? के भाई ये price पे होना चाहिए. This is a price. This should be the growth. Think and tell me. Is this linked to achieving a particular market price? The answer is no. It is linked to IPO. It can be linked to some other factor as well, but this time around it is linked to an IPO. And as a result, is it a performance condition which is market linked or non-market linked? Sir, it is non-market linked performance condition, which means at each balance sheet date, you will try to see the probability of that condition being fulfilled. If it is fulfilled, then you will figure out what is the expected vesting period and then you do the accounting accordingly. If it is not fulfilled, कि भाई IPO तो मेरे को लग रहा है नहीं होएगा, then even if IPO does not happen, then you will have to make a cash payment in the form of cash after 5 years. ये थोड़ा problem देगा आपको question. So the employees might receive free shares at the time of IPO or a cash payment at the end of 5th year, but not both. You're not getting both. So they are not two mutually exclusive plans. It's a single plan, but the choice is not with the employee, not even with the company here. No employees are expected to leave the entity over the next 5 years. Thank you very much. At the date of the award until the end of the second year, it was not probable that a successful IPO would occur before 5 years. So the probability of IPO happening was nil. And as a result, the expected vesting period, there will be no vesting of the shares, but फिर cash तो भरना पड़ेगा. Okay. At the end of year 3 though, a successful IPO now becomes suddenly probable and the management now expects it to occur in year 4. At the end of year 4, a successful IPO actually occurs and employees receive free shares. You'll have to pause and read this question again. The fair value of the equity settled award is 1000 at the grant date. Remember, for equity plans, you have to take the fair value on the grant date only, you cannot remeasure it. But for a cash plan, you will remeasure it at each balance sheet date. The fair value of the cash settled alternative is given to you, ignoring the probability that an IPO will happen or not within 5 years is as follows: 50, 500, 100 and 50 at 4 years. 5th ईयर तो चलो एक्चुअली शेयर्स हैव ओनली वेस्टेड, सो 5th ईयर का लेना देना ही नहीं है. हाउ विल द एंटिटी अकाउंट फॉर दिस ट्रांजैक्शन? नाउ first of all, when you do question 20, you need to be clear that this is not an ESOP with cash alternative, because there is no option with employee. So the steps that you do over there should not be applied over here. Institute has also not applied, and in my opinion that is correct. But ये आपको पहले समझ में आना चाहिए. So this is not an ESOP with cash alternative. Acha, so sir, what is this? Well, over here there's an equity plan and then there is a cash plan. Under cash plan, the vesting period is necessarily 5 years, but cash plan will only happen if IPO not probable in 5 years. अच्छा, if IPO is probable in 5 years, then वो equity shares ही मिलने वाले हैं. Okay, so over here, in this case, when you look at IPO, this is performance condition which is not market linked. If it is not market linked, in year 1, you will look at, sir, this is not probable equity, which means vesting under the equity plan is unlikely. But if vesting under equity plan is unlikely, cash plan vesting will happen after 5 years. When you go to year 2, again this is not probable. If this is not probable, that means there will be no vesting under the equity plan, which means cash plan vesting will happen after 5 years. But when you go to year 3, this will become probable, as the question tells you, and the expected vesting period is 4 years. But if the expected vesting is going to be in the form of shares and the employee does not have a choice over here, in which case you will not again have an SBP liability. It's either SBP reserve or liability. You're not given as an employee option for both. In year 4, probable यानी ये तो actually हो गया, there's an actual IPO, and hence there is year 4 पे actual vesting, and hence cash plan will not be there. So sir, how will the working? Have a broad understanding and proceed. ज़्यादा बेचा फोड़ी ना करे. It's a one-off question. If it comes, it will come on similar lines only. So how will the working happen? Well, when I go to year 1, I will account for this as a cash plan. I look at the number of employees. Do I have the number of employees? Well, nothing is given. So I take 1 employee into options per employee. Do I know how many options per employee? Again, I don't think that is given. So let us say into options per employee, this is 1 into fair value. Now, because this was a cash plan, you will take the fair value at each balance sheet date, which is 50 rupees. यहाँ पे equity plan तो NA हो गया, and hence this is 50. Total EB till date is 50 into 1 by 5 prorated 10 minus earlier recorded 0, and hence your employee benefit expense for the current year will be 10 rupees. When you go to the second year, it is still a cash plan. 1 employee, 1 option per employee, but now the fair value is 500. 500 into 2 by 5 to be recorded till date may be 200 less 10 earlier recorded. Can I say this is 190 to be recorded in the second year? And hence, if I had to pass the journal entries, this is a question asking you to pass journal entry. How will the entity account for this transaction? Your entry will be in year 1 and in year 2. EBE account debit, which will go to the P&L, to what? SBP liability. 10 190. Therefore, at year 2, your SBP liability will come to what? Sir, 200. Now the tables turn. In the third year, is this plan any longer still likely to be settled in cash? No, it is now going to be settled in by entity issuing its own equity shares, but that is after 4 years. So now from year 3 onwards, it suddenly becomes an equity plan. You can even do the working over here. So in year 3, this now becomes an equity plan. One employee, one option. Here what will I take? Will I take 150, which is a value? No. Now cash settlement is not going to happen. Settlement is going to happen in the form of shares. And remember, here the employee doesn't not have an alternative to force you to pay cash. In ESOP with cash alternative, kya hota tha? Employee might say, I don't want the shares, I want cash. So you have a live liability and hence you'll have to pay this. Here the employee cannot force you. If an IPO happens, you will give the shares, employee will have to accept the shares. And hence, now this plan, cash plan in a way gets converted in a way to your equity plan. And as a result, over here, if it's an equity plan, there's single fair value given on the grant date, which is 1000. And hence this is 1000. Till date, 3 years have gone by for this plan. 3 by 4, it is not the first year, it is the third year. Sir, 4 क्यों आया, not 5? Because it is probable that the vesting will happen after 4 years. So 3 by 4, and as a result, this is 750. Less earlier recorded 200, and hence this will be what? 550. But 550 will go in SBP reserve. इसके पहले का जो working है, that was in SBP liability. Now, since IPO is probable, there is no SBP liability, and hence at year 3, you will convert the SBP liability first to an SBP reserve. So SBP liability account debit to SBP reserve comes to what? 200. So 200 is already there, and then in year 3, you will again have employee benefit expense account debit, which will go to the P&L to what? Sir, SBP reserve. This is 550 rupees, and hence you are at 750. When you go to year 4, actual vesting happens and actual shares are issued 1-1. No remeasurement. This is still 1000. 4 by 4. This is 1000. Less earlier recorded 750, and hence 250 to be recorded now. And hence this will be year 4, where you will again have EB, which will go to the P&L to SBP reserve. To SBP reserve, I believe this is 250 rupees, and that is about it. At year 4, actual shares will be issued, so your journal entry will be SBP reserve account debit. I believe अभी आपके reserve में 1000 होगा to equity share capital / securities premium, depending on the face value and other data. Are we clear with this? So this is a slightly more problematic problem. I hope you have managed to kind of get a decent enough understanding for this. This is where I would say your core RTP questions, which you should have referred in this 1.5 hours, they kind of end. I'll spend just a few more minutes quickly discussing the adjustments in the other questions, so that आपके mind में you don't have to again sit and scan through the other questions. So let us review the other questions. Let me just quickly glance through. Let us say we'll quickly discuss this. So we'll not spend more time. These are all similar questions. So if someone wants to scan through, not more than 2 to 5 minutes per problem. P Incorporated in India has 70% interest in foreign entity. P has INR currency, whereas S has US dollars. That is fine. P sells the entire investment in S for 3,200,000. So over here, that is a stake sale where we lose control. The following information is provided. Net assets. S, I would have consolidated 100%, and FCTR 900, out of which my share is 630, NCI share is 270. How does an entity account for on disposal? So over here, what you will do is, on disposal, you will receive in your bank account 3,200 to net assets. You will remove 4,000, but at the same time, NCI, that is 30% of 4,000, 1,200 will also be removed, and hence ideally the balancing figure now will be 3,200, 1,200 minus 4,000. I can say is 400 will be the balancing figure, will be the gain, will going to the P&L account. Now other than this, there must be some FCTR balance, but remember, whatever is NCI share of FCTR, it got eliminated along with that. Your share of FCTR, I believe, is 630. Now FCTR is a part of a reclassifiable OCI, and hence on the happening of certain events, a balance over here will be transferred to the profit and loss account. And as a result, over here, this will be to profit and loss 630, and hence a total of 1030, I believe, will go into the profit and loss account. 1030 in total will go to the profit and loss account. Question number 16 for you. Then you have question number 15. In question number 15, you have this company H who has acquired all the share capital for business of S for 15 lakhs. Everything is in thousands, so this is 1500 in thousands. So there are different tax jurisdiction. H ka tax rate is 30%, S ka tax rate is 40%. And you have been given book values and tax base. At the end of it, these are the numbers. Now if I want to find deferred tax, step number 1 is carrying value. Carrying value is as per Ind AS 1070. Step number 2 is tax base, that is 920, and hence the difference between the two is approximately 150 rupees. That is a taxable temporary difference into subsidiary's tax rate of 40%. I believe this will come to what? 60 rupees. This will be your deferred tax liability. Irrespective of what is there in your books, it does not really matter. In consolidated accounts, 60 rupees will be your deferred tax liability, which means if I have to calculate goodwill, remember there is no deferred tax to be calculated from on goodwill. There is an exemption. You will take PC. Purchase consideration will be 1500 plus NCI. There is no NCI over here. Less net assets, which is 1070 minus 60. This is 1010, and hence the difference of 490 will be recorded as goodwill, and that is about it. Question number 15 for you. Next you go to question number 14. Over here, P has acquired 30% stake for 8,000. That will give us significant influence on 31st March 12. 1 year later, recognize our share in net asset changes as follows. Share of profit and loss, OCI, FCTR, revaluation, which means 8850 will be my investment as per the equity method. So I must have passed the entry investment account debit 850, to consolidate P&L 700, to consolidate FCTR 100, to consolidate revaluation 50. Remember, FCTR is reclassifiable, revaluation is non-reclassifiable. On 1st April, PQR acquires the remaining 70% stake for 25,000, which means over here this is your purchase consideration for the remaining 70%. This acquires control, so you'll remeasure your existing investment to fair value and take the gain or loss to P&L. The following additional information is relevant. Fair value of 30% stake is 9,000, but you have recorded it at 8850, so 150 ka gain additionally will go to the P&L, and my investment will appear at 9,000. Investment account debit 150, to gain on remeasurement 150, and my investment comes to 9,000. Fair value of identifiable net assets is 30,000. How should the business combination be accounted for? Sir, PC will be how much I am paying for the 70% stake, that is 25,000, plus the fair value of the existing 30% stake 9,000. So PC is 34,000. There's no NCI because you're acquiring 100% stake, and net assets are 30,000, and hence your goodwill will be 4,000. Now if I had to pass journal entries over here, I would say that when control is acquired, net assets would be debited. For example, at 30,000, to bank would be credited at 34,000, to investment, which is after remeasurement, you must have done the remeasurement, credited at 30, बैंक में कितना पे किया 25, sorry not 34, बैंक में 25 is paid and then 9, and hence the remaining 4 balancing figure will be taken as goodwill. Acha, but what will happen to the balance which is there in FCTR and revaluation? This will be transferred. So FCTR 100 will be transferred to the consolidated P&L account, whereas revaluation reserve of 50 will be transferred to retained earnings. Now you can combine this and pass this as a part of a single entry, where as a part of acquisition you can say net asset हमारा 30, goodwill is 4, to bank 25, to investment, for example whatever it is 8850, 150 ka gain will be taken to the P&L. Further 100 ka gain will also be taken to the P&L. So 150 and 100, 250 of gain goes to the P&L, and separately 50 will go to the revaluation reserve to return earnings. So that can even be shown as 250 ka combined gain in the P&L and another 50 to the revaluation reserve. That will also work. This is question number 13. 14. Then you have question number 14. Question number 13. On 1st April, this is early redemption. What happens over here is you will have to split the liability and equity component at the time of early redemption or early repurchase, and the gain or loss attribute to the liability component goes to the P&L because it is debt settlement expense. Gain or loss on the equity component adjusted against the retained earnings. So on 1st April 20X1, A issues a 10% convertible debenture with a face value of 1000, maturing on 31st March 2011. This is after 10 years. The debenture is convertible into equity shares of A Limited at the option of the holder. So this is an optionally convertible debenture at the holder's choice, which means the principal also has the liability component at the conversion price of 25. This is conversion price. Redemption unless otherwise given will always happen at par. Interest is payable half yearly in cash. This was not there in our material. So we had annual here. This is half yearly, which means there are 10 years. Can I say 10 years will be equal to 20 half years? So a discounting will be done on 20 half yearly basis. On the date of issue, A could have issued non-convertible debt with a 10-year term bearing a coupon rate of 11%. This will be per annum, that is 5.5% for a 6-month period. So if I want to split the liability and equity component, what will I do? If I want to split at year 0, I will say that every year 1000 rupees into what is the coupon rate? 10% per annum, that is 5% into the PVAF at the rate of 5.5% market rate of interest for 20 periods, plus because it is a optionally convertible instrument, present value factor at the rate of 5.5% for the 20th period. Let us say you have calculated the present value factors at 11.9504 and 0.3427, let us say 0.3427, which means this will be 50 into 11.9504 and 1000 into 0.3427. This is totaling up to approximately 940. Maybe here or there rounding off, but approximately 940. Which means this is your liability component. Therefore, your equity component would be the balancing figure, that is 60 rupees. Okay. On 1st April 2016, maybe 5 years later, convertible debentures have a fair value of 1700, but that is fine. We are going to record liability component, equity component separately. A Limited makes a tender offer to the holders of the debentures to repurchase at 1700, which the holder accepts. On the date of repurchase, A could have issued non-convertible debt with a 5-year term with a coupon rate of 8%. 8% is per annum, which means 4% for 6 months. Which means over here, you will have to split the 1700 again into liability and equity component. So this is your book values at year 0. When I go to year 5, your liability component will change. Why? Because of the amortized cost working. Remember, you will prepare amortized cost table. Opening is 940 plus effective interest at the rate of 5.5% less 50 paid closing karte you will find a balance. But your equity component will continue to remain at 60 only. Let us say I prepare an amortized cost working, and for the timing, let us say I get my ledger balance. I don't know at kitna lena hai? Maybe 962. Let us say trust karenge. If you want to prepare an amortization table and you come to 962. Now in your ledger after 5 years, liability component which started at 940 is now at 962. Equity component of 60 cannot be remeasured, is at 60 only. But now you are repaying at 1700. Is that 1700 only for the liability? No. Is it only for the equity? No. Is it for both? Yes. Which means I have to segregate the 1700. How will I segregate the 1700? Well, over here, if I had to do that, for example, this was question number 13. At 1st April 2016, I will try to say that 1700 में से something will be towards the liability component, which is 50 into the PVAF at the revised rate 4% for the remaining 10 half years, plus 1000 into the present value factor at the rate of 4% for the 10th period. Whatever these numbers, let us say 0.6756, 8.1109. 8.1109, 0.6756. You can sit and calculate this. If I calculate, answer क्या आएगा? 50 into 8.1109 m plus 1000 into 0.6756 m plus MRC. Maybe this is around 1081 or 1082, which means the remaining will be towards the equity component. 1700 minus 1082, maybe 618 is towards the equity component. So on 1st April 2016, your journal entry would be liability component in your ledger is 962 to bank. Towards that you are paying 1082, and hence the balancing figure, if any, 962 minus 1082, this is approximately 120. This will go to P&L as debt settlement expense. It is excess amount that you are paying to settle a liability, and hence will go to the P&L. Whereas when I look at the equity component in your ledger is 60. For that, ultimate payment that you are doing is maybe 618, and hence 618 minus 60, maybe this is 558, will directly go against retained earnings, reserves and surplus, because this is settlement against an equity component. So if I can cross match these two numbers over here, let us say 558 reserves and surplus, this is on equity component, and earlier this is 120 in the P&L towards the liability component. This working is done similar to what we have done over here. Now let us say we have done all the descriptive ones. We'll also discuss the first case study based MCQ. This over here, what is happening, if you quickly review this, ABC is a dynamic company hone do, doing strategic acquisitions. As a part of the growth strategy, you have recently acquired PQR, that is one of your acquisition, RST another acquisition. While these acquisitions present growth opportunities, they also include ongoing lawsuits for the acquired companies. ABC has secured indemnities from the respective sellers to mitigate the financial risk associated with these legal matters. Following acquisition took place during the year. Okay, first ABC acquired a beverage company PQR from XYZ. At the time of acquisition, PQR is a defendant. This is exactly same, zero changes as compared to question 49 of our Index 103 business combination material, on which the first 4 MCQs are based. We'll quickly review this. ABC is a beverage company. PQR acquires beverage company PQR from XYZ. At the time of acquisition, PQR is a defendant, which means cases are going on whereby certain customers have alleged that products of PQR contain pesticides in excess of permissible levels, which have caused them health damage. PQR is being sued for damages of 2 crores. XYZ is indemnified ABC for losses, if any, due to the case amounting to 1 crore. The fair value of contingent liability for the court case is 0.7 crores. That's fine. So what is happening? There are 3 numbers. The demand is 2 crores. Indemnification is obtained up to 1 crore, but the fair value of contingent liability is 0.7 crores. Now based on that, the first 4 MCQs are there. At what amount would ABC account the identified liability relating to the contingent liability and indemnification asset? Well, liability will be at fair value, that is 0.7, and indemnification will also be at the value at which contingent liability will materialize. So if the contingent liability materializes at 0.7, indemnification will be 0.7 ka hi milega, not 1 crore, and hence this is 0.7 and 0.7, option D. What will be the impact on goodwill due to recognition of liability and indemnification asset? No impact. Why? Liability increases by 0.7, asset also increases by 0.7. There is no impact on the balancing figure. So there will be, the net impact on goodwill will be nil. Answer is A. Suppose in case of fair value of the identified liability is 1.2, in which case contingent liability will be 1.2. However, indemnification maximum 1 crore ka milega instead of 0.7. Then what will be the value of liability and indemnification asset? Liability will be 1.2, indemnification will be 1. Answer will be point B. What will be the impact on goodwill due to the recognition of such liability and indemnification asset? So I don't know what the PC is. I don't know what net assets is. So let us say whatever be the net assets, let's say 100. Now over here, your liability of 1.2 is recorded. And let's say, for example, there is no NCI. Let's say 120 is the PC, so your goodwill is 20 rupees. Now, if these ongoing lawsuits come in, my contingent liability will be recorded at 1.8 and indemnification asset will be recorded at 1, which means if I now sit to find the balancing figure, my balancing figure will be hypothetically 121.2 minus 101. Can I say 20.2? And hence can I say due to this, my goodwill will in a way increase by 0.2. So there will be a net increase in the value of goodwill, I believe, by 0.2. So ये थोड़ा आपको सोचना पड़ेगा. तो maybe 0.4 करे. Hypothetical numbers I have taken. You can fundamentally say कि भाई my PC remaining the same, other net assets remaining the same, my liability is increasing by 1.2, asset is increasing by 1, which means my net liability is increasing by 0.2, my net assets are falling, PC remaining the same. If net assets fall, goodwill increases by 0.2. Otherwise, you can take hypothetical numbers and come to this ultimate conclusion. And the last thing, जो अलग case है, but it is easy. ABC pays 50 crores to acquire RST from MN. RST manufactured products containing fiberglass and has been named in 10 class action suits, that is suits in US, concerning the effects of fiberglass. MN agrees to indemnify ABC for the adverse results of any court cases up to an amount of 10 crores. So there's an indemnification up to 10 crores. But the class actions have not specified amounts of damages, and past experience suggests that claims up to 1 crore each. This is based on past experience, but they have often been settled for very small amounts as well. Demand भले वो 1 crore कर रहे हैं, वो small amount में settle हो जा रहा है. Now ABC makes assessment of the court cases and decides that due to the potential variance in outcomes, contingent liability cannot be measured reliably, and accordingly no amount is recognized for the court cases. Remember, you can recognize if fair value can be measured reliably. If you cannot measure something reliably, you can't record it at all, in which case you will neither record the indemnification nor should you record the liability. So over here they say, on acquisition of RST, what amount of indemnification asset should be accounted for 10 class action suits? The answer is nil, because सामने liability recognized नहीं हुआ. If liability was recorded, then up to a maximum 10 crore indemnification you could have recorded, up to a maximum, but that is provided liability was recorded. In this case, because the question very clearly tells you that the liability will not be able to be reliably recorded, you don't record the liability, in which case you don't even record the indemnification. So that is it, your entire RTP along with MCQs, descriptive questions, new questions, everything that is covered. I hope this video has been helpful for you. If yes, please do like, share, and also mention in your comment box if you have any feedback for this. Your love means a lot to us, and if you like the video, it can help us in reaching more people as well. So that's about it. And at the end, I'll just say that the RTP is there. It is a little tricky. There are two questions, especially 12 and 20, which are a little daunting. But what comes in the RTP does not necessarily come in the exam. So RTP questions historically for FR, if you compare AFM, it is different, have been always been a bit dicey, but the exam questions are not necessarily like that. So don't let the RTP deter your confidence, and if it does come, there will not be a question like question number 12 which will come afresh in your exam. At least in my past experience, they will twist, ask some reverse working, but a full afresh question, unlikely. And even if it comes, it is one question out of a very big paper. Let this not deter your confidence. Let you not have that self-doubt, okay, oh, I've studied so much, still there is more. It is a quicksand. No matter how deep you go, there will always be something more. When you become a partner in EY, you will still learn new things over there. So don't go into that oh, consolidate on your strength. Focus on the fact that, okay, even if there were 20 questions in your RTP, 18 you could solve, 2 you struggled, but 18 you could solve. That is 80% marks in your exam, which is, well, what toppers get. So there will be certain areas where you might face difficulty, but those areas should not let you bog down on your overall. Think of the fact that 80% of the areas I can manage, the other 20% I am trying by my best, but then in costing you call it as normal loss. Thoda bahut hoga idhar udhar, but by and large, keep your confidence in order at this stage. That is the most important asset that should be there with you no matter what. Okay? That should be it. I have full faith in you. You should have full faith in yourself. That is the most important thing. I'll see you soon with more videos. Till then, bye bye, take care and good luck.